Hi everyone, this presentation is for informational purposes only and does not constitute investment advice. The views expressed are based on historical analysis and publicly available data. Welcome to David This Channel. If you like this video, do subscribe, share and like this channel so that more people can benefit from learning from this. In this video, I want to walk you through how I'm thinking about the US dollar right now and how I'm positioning my portfolio sitting here in Singapore using Ray Dalio's late-stage empire framework. Let's start with the big picture. Dalio's view is that the United States is in stage 5 of its big cycle, the phase where an empire is still on top, but the foundations are visibly cracking. The US dollar is still the world's dominant reserve currency, but the forces that made it feel risk-free are weakening. Debt is huge, politics are combative, and trust in US institutions and money is slowly eroding. So what does that actually mean for someone like us managing capital from Singapore? It means I no longer treat the dollar as a neutral backdrop. I treat it as a risk factor. I assume two things. First, that over the cycle, real returns on US cash and long-dated treasuries are likely to be poor, sometimes negative, because the easiest way for the system to cope with too much debt is to devalue the money. And second, that we are moving from a one-pole world dominated by the dollar to a more fragmented system where other currencies and real assets quietly gain share. With that in mind, here's the portfolio logic I'm using. I start by making a clear distinction between three things. Number one, the dollar as a currency. Number two, US assets as investments. And number three, real assets that sit outside the fiat system. On the currency side, I'm careful not to make my net worth a one-way bet on the USD. I live in Singapore, and the Emas manages the Singapore dollar against a basket of currencies to keep inflation under control. That means SGD is already designed to be a kind of regional, real value anchor. So I want a meaningful portion of my liquidity, my dry powder, in SGD cash and short-term SGD instruments, not solely in US dollars. On the US asset side, I'm still comfortable owning American business, but not blindly owning American money. That leads me to tilt away from long-duration US government bonds. I'm tilting more towards two things: quality US equities and shorter duration USD credit, where I'm actually being paid for the risk. I want exposure to US innovation and global revenue streams. I'm very reluctant to sit in 10 or 20-year treasuries. If I need bond-like safety, I'm more interested in shorter maturities, where I can roll and adapt as policies and conditions change. Now let's talk about gold and real assets, because this is where Dalio is unusually explicit. He keeps coming back to the idea that most of what we call money is actually someone else's IOU. Your bank deposit is the bank's liability. Your bond is the government's liability. If the system needs to be fixed, those liabilities are where the adjustment happens, through inflation, financial repression, or taxation. Gold is different. It's not anyone's promise. It doesn't depend on a central bank or a finance minister. That's why Dalio sees it as a kind of Noah's Ark asset in late cycle environments. So in my own framework, I'm comfortable thinking about gold as a core, strategic allocation, not a trade I'm trying to time. A reasonable range is around 10 to 15% of the portfolio. Around that gold core, I add other real assets: energy and resource producers, infrastructure, select REITs that can pass through inflation. I want things whose value tends to float up with debasement. Let me put all of this into one concrete mental model. Imagine breaking your portfolio into 5 buckets. Bucket 1, gold and monetary metals. Roughly 10 to 15% are structural insurance. Bucket 2, other real assets, maybe 15 to 25% across commodities and real estate. Bucket 3, global equities. Roughly 30 to 40%, focusing on business quality and balance sheets. Bucket 4, non-US, non-SGD developed market assets, perhaps 10 to 20%. And bucket 5, SGD liquidity, around 10 to 20% in cash and short-term paper. Your oxygen tank. You'll notice what's missing: a huge slug of long-duration US government bonds. That's deliberate. I want to be long, productive assets and real stores of value, not sovereign promises. From there, I think in scenarios. If the world muddles through, inflation drifts down, growth is okay, then a traditional 60-40 portfolio might do fine. Insurance costs something. If we get a classic late-cycle stagflation, slow growth, persistent deficits, then my underweight in long USD bonds and my overweight in real assets should protect my real wealth. And if we see a more disorderly phase, where conflict weakens confidence in the dollar, then the combination of gold and non-USD assets will matter a lot. The point of this structure is not to forecast the exact path. It's to make sure I'm not relying on one fragile assumption that the dollar will always be the unquestioned backbone of my portfolio. Instead, I'm treating the dollar like what it actually is in 2026. Still powerful, but aging. Still dominant, but increasingly politicized. Still useful, but no longer the only place for long-term promises. If this resonates with you, take your current portfolio, map it into these buckets and ask, if Dalio is roughly right about stage 5, where am I most exposed to the wrong side of that cycle? Once you see that clearly, the rebalancing decisions start to reveal themselves. Thanks for watching, and I'll see you in the next one.